Very often I get asked which is the optimal compound period. So when it is the best time to actually increase your account size and start calculating the new risk per trade on the new account balance. So I wanted to make a video explaining this concept in detail. So that is exactly what we will be speaking about in this video. Now, if you're new to the channel, I'm a top author on the TradingView platform and I share every single day a lot of free education and analysis. So I really do suggest that you subscribe to the channel so you won't miss out on all this free education, and I will see you in the video. I always speak about analysis and obviously free education. So how you're actually supposed to be developing a strategy. I'm sure that you learned a lot from all my free analysis and education, and some of you might actually now have a profitable strategy or of their own, or probably they have now developed a proper strategy. If not, obviously learned mine. Now, at this point, you have a choice to make, now that you are consistent. So you know how to analyze the market from a monthly, weekly, and daily perspective, looking at the directional aspect of the market. You also know how to use intraday timeframes to find confirmations and entries. You know how to read the order flow, so the commitment of traders, and what hedge funds are doing in the market to gain an advantage over your competition in the market. You know how to do all these things, and you now are trading the market profitably. Well, at this point, you do have a question. How are you actually supposed to be compounding your account? Or even in the first place, you have to decide if you want to compound or if you do not want to compound. Now, if the question is yes, I want to compound my account, then again, you have some other questions that you're supposed to be asking yourself. On which time scale am I supposed to be compounding my account? And that is exactly what I will try to explain in this video. Which are the benefits and obviously negative sides of all the different timescales on which you can actually compound your account. Now, immediately we have to make a distinction. We have to distinguish between being a swing trader and a day trader. Now, if you are a swing trader, which are the different options when it comes to compounding your account? Now, in my opinion, there are two main choices, two main options that you have when you are compounding and you are a swing trader. You either compound weekly or you compound every month. I don't suggest that you go lower than every week, okay? Now, the difference between compounding your account every week and every month is that now if you are compounding your account every week, you will have softer curves. Now, why you will have softer curves? Because when you will be, let's say you are in a losing streak, okay? You are losing trades. If you are losing trades, but every week you recalculate your new account balance, then what will happen is that week by week you will be always losing less because you are obviously risking less per position. Because let's say, for example, you're risking 1% per position, the new week, if you have lost, your 1% of your account will be less than the 1% that you had in the previous week. So basically, your account balance will be softening up. The curve of your equity will be softening up because you will be always losing less and less. On the other side, if you are in a winning streak, what will happen is that your account will be building up more quickly because obviously the 1% that you're risking per trade will continue to increase week by week as you are winning. However, there is a problem. Even though you do have like these curves that are a little bit softened up when you're losing and they are increased when you're winning, what they bring is a problem. What if you are winning trades, then losing trades, then winning trades, then losing trades inside of the different weeks? So 1 week you win, 1 week you lose. What will happen is that every time you go and recalculate your account balance, you will have fluctuations that are not very predictable because obviously you will not like win all trades and then lose all trades. So this brings some complications, which is why me personally, I prefer a more linear approach. To have it every month, okay? At the end of your trading month, what you do, once you have enough trades, to actually have a good performance, because when you're swing trading, obviously you will have less trades than when you're actually day trading. What I like is a bigger amount of trades, and the more trades you have, the more the law of the big numbers can actually apply, meaning that your actual edge in the market will play out over a large amount of trades, which you can have in a month, but you cannot have in a week if you are swing trading. So basically what I suggest when you are swing trading, at least me personally, then obviously you can take your own conclusions, is to compound every month in a more linear approach. So you recalculate your new account balance for the month, and then the next month you always risk the same amount. That is what I suggest personally. Now there are people that compound every trade. So every trade they recalculate the new balance that they have. I do not suggest that, because there are many reasons for which I do not suggest that, but simply reassumed, it is a lot less linear. And when you are day trading, there are two main options that I suggest: either every day or every week. Now this brings to the very, very similar conclusions that we already had from a swing trading perspective. Now, if you are compounding every day, will you have enough trades from a big numbers perspective for your edge to actually play out in the market? Probably not, okay? However, every week from a day trading perspective, you will have enough trades for your actual statistical edge to play out in the market, which is exactly what you need. So my suggestion when it comes to day trading is, even if compounding every day might seem a good idea because you're always softening up the curve if you are in a losing streak. However, if you are in a winning streak, yes, you are compounding more quickly. That is not how usually things play out. You will win trades, lose trades, win trades, lose trades, losing day, winning day, losing day, winning day. So what I suggest is anyway to give time to the market and your trades to actually play out from a statistical edge perspective. Give enough numbers for your statistical edge to actually play out in the market. Therefore, I suggest also from a day trading perspective to compound every week, which is way more linear, because over a week you have given the market enough trades to actually let the law of big numbers actually play out and your statistical edge actually play out in the market. Therefore, you will have a more linear performance also when it comes to your compounding. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free education and analysis for all of you. Also, make sure you go and check out the mentorship program. You find it linked in the description. You first learn all the rules of my rule-based strategies in the program, and then you trade them live with me. In fact, every single day you get a new daily market breakdown showing you exactly how to apply the strategies with entry, stops, take profits, as well as having me answering every single question that you have every day, including the weekends. So I really suggest you go and check it out. The link is in the description, and I will see you in.